Welcome back. What we're discussing today is that the fixed maturity plan of Kotak Mutual Fund has said that it will return the principal and part of the interest and hold back a part of the interest. Although the maturity date is mid-April, they will have to hold it back because the collateral is Z Entertainment SL Group shares, which the company has entered into an agreement with some of the holders of the shares, holders of the pledged shares, that they will be able to sell off the company probably by September 30th. And therefore, that money, that part of the fixed maturity plan's money is probably going to be realizable only sometime by September 30th. And hence, only part of the interest has been paid to the investors in the fixed maturity plan. We are speaking with Manoj Nagpal, Sandesh Kirkire, Dhirendra Kumar and Sandeep Parekh about whether this is the best way to go about a fixed maturity plan. Well, my question to you, Dhirendra, is transparency. Even now, we don't know how many mutual funds have, for instance, Anil Ambani Group shares or pledge shares. Even now, we do not know the names of all the parent companies. So is there a serious lack of transparency in terms of what exactly each fixed maturity plan is holding? Or for that matter, any debt fund is holding?
Yes, there is a need for, little more explanatory transparency, because it could just be in a compliance transparency that we see right now. Because all the kind of securities, you can't really make out what it stands for, because these are all holding companies and all kind of subsidiaries which could be borrowing money. And particularly the ones where we see that, such a context that you have investment in a security, but it is backed by some external collateral or other things backing it. So you definitely, because getting a rating based on, because even those ratings are issued, they are almost like a structured obligation. A rating agency can issue a high rating to a company if the collateral, and that particular tranche of issuance, which is backed by some collateral by the promoter. So in that sense, I think it needs to be a little more explanatory so that investors can decode that. But more importantly, I would say that if we follow the spirit and things are being followed in letter. If we follow and the formula is being followed, but if we follow the spirit that everything, the underlying thing, the net asset value has to be realizable, then I think the debt fund industry has to shrink by 70% because it is not the reality.
Okay.
Yes.
Yeah.
I think about 95% of the assets don't get traded.
Yes.
What gets traded essentially is the government security, the CP and the CD market.
Yeah, we did the calculation for that month, January. Out of 6 lakh crore of assets held, I think 18,000 crore was traded.
So around 97%.
Yeah.
Now the issue is, Infosys has a closing price. The same price goes into the NAV of all funds. What do you do with the bonds? So somewhere in 2012 or 13, when the entire guidelines changed, today a rating agency is actually providing you with a price. The price is linked to, perhaps, the issue is not about accuracy, the issue is about consistency, so that every fund house has the same kind of valuation. Issue happens below 60 days. That below 60 days itself is also, well, it's not only amortized, but it's also valued in a sense. So some degree of fairness is there. The issue is the question being asked that, perhaps you should have been informed more, disclosure should have been positive. Yes, because the holding companies are not necessarily in the name of the listed company. That's the big risk that the equity market is today carrying, because how the fixed income, the company may not do badly, but the founder's holding can impact the share price. So the disclosure, I agree, there has to be, but what do you do with, in a fixed maturity plan when you're holding the security to maturity? You are not, there was a time prior to 2008 when the fixed maturity plans used to invest beyond the maturity of.
Oh yes.
So all that has been cleaned up now. Yeah. Now you are actually holding it to maturity. What do? You have to hold it to maturity.
Yeah, that's why I began by asking whether it was an inappropriate product at all. But yes, they would have thought that this is even more liquefiable than a bond at that time, Z shares. So that would be the explanation. But
on a normal time, actually a security of that nature is very liquid, because everything else is liquid.
That's what I'm saying. Yeah. So that would have been the perception when they entered the product. But Sandeep, nobody pays for this crime. That is the problem. How do you penalize? One suggestion was that perhaps, the mutual fund should have some seed capital in at least credit risk funds or perhaps in all debt funds. The other suggestion is cancel license. How do you ensure accountability?
So, Latha, I think the answer is there in your question itself. I think nobody pays for the crime because it's not a crime, it's not a violation. And it's, I would argue it's not even an error of judgment because, it's very difficult to predict the future. I mean, nobody knew 3 years back that Jio is going to come and, pretty much all the, even the large incumbent telecom operators are going to be highly stressed today. So I think it's very difficult to predict that in 2 years or even in a short period of 1 year, somebody is very, very healthy and some turns turtle. Not just for you and me as lay investors, but for expert fund managers, it's very difficult to predict the future. And if you read the works of Taleb, you know that.
Yeah.
Black swan
Sandeep,
events are far more frequent than we think they are.
Sandeep, we take your point that it's difficult to predict the future,
so my point
that is why a retail investor is entrusting their money to a fund manager who's supposed to be way more qualified.
So, I mean, he's supposed to be more wise, but not God. And that's my answer to your question.
We're out of time, so Manoj, just one final.
Do make mistakes in hindsight, but again, if they're honest mistakes. No, my point is, if they're honest mistakes, they are not crimes and they're not violations. And everybody is entitled to make mistakes. All of us do make mistakes.
Okay.
Fund managers are experts, no doubt, but they also do make mistakes.
Manoj, one question to you actually before we run out of time is that we're now getting news that one of the AMCs which had a FMP which was due for maturity in the next few days has decided to roll it over by a year. What does this mean now for the product itself? I mean, if the fiduciary responsibility of AMCs to their investors is being flouted like this by either not returning part of the interest or now deciding to roll it over, is it the end of the line for an FMP?
Well, when you look at this kind of problems that happen, there are 3 options that a mutual fund has. Earlier, the option used to be followed is that the AMC used to take the hit on their books and, the investor was protected. Obviously, that is not the correct method because mutual fund is a pass-through vehicle. The second is, try to roll over the FMP, which is an option given to an investor. Most of the FMPs have, very limited investors, between 100 to 500 investors in per FMP. So it's very easy for a mutual fund to go out and explain to each investor. So this concept of not reaching out to investors with only 100 to 500 investors in a FMP, I think is something that cannot be, ignored. That is what, the FMP will try to do now. In this case, HDFC FMP, which is rolling out for 1 year. And the third thing is what, currently the Kotak FMP has done, that is declare an incorrect NAV and pass on. There is no regulation within the Mutual Fund Act that says that if the NAV of a product is 12, you can only pay out 10 today and 2 after some point of time, and you may or may not pay. So that is a complete violation of the entire SEBI Mutual Fund Act itself. NAV, if there is a redemption...
So what else could they do? The money is not there with them.
No, let's understand why they did not mark down the security.
Okay.
The reason the security is not getting marked down is because this security is now present in various other mutual fund schemes also of the either same fund house and others. They'll have to mark it down. So taking a grey line saying that my NAV still remains high, the value is that if the marketable value or the realizable value is 12 and you're paying out 10, under which regulation are you doing it? Where is that provision? There is no such provision. The trustee has to question, the SEBI also has to question.
Okay, fair point. Well, very quickly, I'm trying to squeeze one more question. The mutual fund industry has actually spoiled the risk measurement in the market. When an NBFC was giving loans against shares, he was raising money at 8 or 9%, and therefore he was pricing the risk correctly. When the mutual fund is getting money free, and so he underpriced the risk. How do you set this right?
No, you see, the pass-through structure.
Exactly.
Pass-through structure.
Now, the LAS has completely moved from the NBFC to the mutual fund because this guy underpriced it.
Just look at it this way, that if you want to give 100 rupees of loan to L&T, as a bank, you need 9-10 rupees of capital. You don't need, so there is a cost of equity and there's a weighted WACC cost which is very different.
But this guy
there's
does-
no WACC cost.
Exactly.
Since there's no WACC cost, the entire credit pricing gets distorted by the fund industry,
Yes.
because he's only interested in producing better performance vis-a-vis the rest of the industry.
I know the question, but I don't know the
But
answer,
look at-
and SEBI has to find
But
an
look
answer
at,
to
the
this.
industry today is larger. The car part of the CASA is smaller than liquid funds now. So what we are saying is but the car part would have fetched at least 6% interest to the bank.
Okay, I have one key question to both our mutual fund advisors very quickly. Do you think now people will flee these funds, Manoj? I want to flee.
Clearly, there is going to be a scare when people don't get their money, and that's a committed contract between a mutual fund and, irrespective of the fact that only a part is left, but I think this product is definitely going to see a squeeze on this. Even people will not roll over, though people may try to. Yeah? So retail investors are going to be very wary of this and go back to traditional fixed deposits.
Yeah, but Dhirendra ji, same question to you actually. I advised, one of my very close relatives, oh my God, this is all looking scary, let's go back to LIC annuities. He was a retiree or a potential retiree. The conversation we had was, let's just go back to an LIC annuity or an FD. These products are looking scary, or a gilt mutual fund at best. Do you think other investors will react panically?
Yeah, if, it's a grim reminder that, somebody did not listen to the statutory disclaimer there. There's a subject to market risk. Somebody came to optimize his return. If somebody thought that this was a fixed deposit, he was in for a surprise and he's getting the surprise. You get Mr. Risk visits you once in a while.
Okay.
And I don't think this is a calamity of that kind.
Okay, fair point. Maybe the fund industry already saw part of that, saw the trailer in August, and therefore it may not be very calamitous. That's a separate issue, of course. It's an industry issue. For the investor, I think mutual funds are subject to market risk is a lesson that they have learnt the hard way. Dhirendra, Sandeep Parekh, Sandesh Kirkire and Manoj Nagpal, thank you very much for joining us in this conversation.